Hello everyone, welcome back to the audit and attestation class. In the previous video, we have understood 4 rules for the member out of the 9 total rules, right? In the previous video, we have checked on integrity and objectivity rule, independence rules, journal standard rule and accounting principle rule. So in this video, we'll be learning the 5th rule, which is act of discreditability rule for the CPAs. So let's dive into this session.
Let's come back to AICPA Code of Professional Conduct and nine rules of this. So far, we have covered I think 4 points. First one is CPA should maintain objectivity and integrity. So that's required in Rule 1, integrity and objectivity, as well as required in General Standard Rule. Then second is independence, free from any conflict of interest, which is required by integrity and objectivity rule, independence rule, as well as general standard rule. Then we discuss when CPA is considered in a violation of any respective rules, right? So we discuss all these things like safeguard required to be applied, relationship, due care, anti-discrimination, supervision requirement, misrepresentation of fact, subordination, failure to document, all those things, and advocacy, failure to comply with applicable law and regulation, right? So now we are coming to the 4th point, which is when threats are not at acceptable level. So in the respective law, respective rules, there are certain points which says when threat is not considered to be an acceptable level. So if threat is not an acceptable level, then you would not be performing that respective engagement. It is better for you to quit, or it's better for you to withdraw from that engagement. So, but when threat is considered not to be an acceptable level, right? We, as a CPA, we should know when threat is higher the certain acceptable level, right? First one is taking the responsible step before accepting any engagement. So when you're taking any engagement, so it's being your primary responsibility to do the respective diligence, to do the respective inquiry, to do the respective risk assessment procedure, and you should not be accepting an engagement which is at very, very high risk, right? And for which, as an CPA, you may not apply the sufficient and appropriate audit procedure to cover the respective risk. So you should not be accepting those kind of engagement. Second is, if you've found an engagement which has high risk, but still you want to accept that engagement, right? So you need to make an appropriate roadmap how you will be bringing those risks down to an acceptable level. For that, you need to do certain procedure. Certain procedure include discussing with the superior. For example, if you are a young partner and you are accepting any new engagement, it is good to discuss with the senior partner. It is good to discuss with the quality review partner. It is good to take internal consultation from the respective management of the CPA firm. It is good to go through the rules and regulation of the CPA firm or quality standard maintained by the CPA firm before accepting such engagement which is at high risk, right? Second thing is discuss with the higher level of management. That means with the company management for which you are accepting the engagement, it is always good to be upfront discuss that these are the risks which is hesitating me or making me uncomfortable to accept this audit engagement, right? And probably something upfront, you may feel it's high risk area or maybe the high risk engagement, but management will give you the detailed interpretation or detailed clarification or more information that make you comfortable to take the right decision, right? It is always good to do the internal consultation with your superior, within your management, within the quality control standard, or it is always good to discuss with the management these are the points on which I'm not comfortable accepting this engagement, and try to understand management explanation and interpretation and verify the documents and supporting which is being provided by the management to make you feel comfortable that whether you can go ahead with that engagement or you should not be going ahead with that engagement, right? Fourth is check the requirement, if any, for reporting difference of opinion. So if you see that any engagement is a high risk engagement on account of particular things, right? On account of any law, regulation, industry. For example, let's say you are doing an audit of any liquor industry, right, which is highly regulatory environment, right? Or maybe an oil and gas industry, which is very much highly regulated environment, and you can say internationally highly regulated environment. So requiring to fulfill the compliance of those international law or those respective industry law or those ministry or those department laws, probably you are not comfortable with it, right? So it is always good to check the requirement for the respective law or regulation, and if there is any difference in what you think and what management think, then how to deal with those differences in future. So you should be having a clear-cut lay down interpretation of if there is any difference on account of the interpretation of the law regulation comes when you are performing the audit, and how you both management as well as CPA would be dealing with those differences. Third one is consult with counsel. So AICPA also have the counsel, right? For example, like for big CPA firm like PwC, EY, KPMG, Deloitte, Grant Thornton, all these big companies, they have their own internal counsel. They also have internal advisory board. They also have senior and experienced CPAs. But look at like small CPA firm, individual CPA firm, or Tom, Dick, and Harry kind of small CPA firm, right? They do not have like senior CPA. They do not have so much experience. They may not have so much expertise, and they all the time are looking at right, left, and center to the new clients. And luckily they got some new client, which is, let's say, in a liquor industry or oil and gas industry or any telecom industry or any highly regulated environment, right? So where do they go for consultation? So for in that case of scenario, AICP also have a council board. AICP also have a council committee, so where they can go and take the consultation from the respective body, right? Makes sense. For example, if you're a small CPA firm and you are not comfortable with any law, rule, regulation, industry interpretation, or you are not comfortable in taking any new assignment, high risk assignment, but you want to take the consultation, then where should you go? You can go to the AICPA consulting body and you can ask for the consultation, whether as a CPA I can accept this engagement or I should not accept this engagement, right? Then all the things, all the consultation, interpretation, clarification, whatever you will be doing, it's being your primary responsibility to do the appropriate documentation of your understanding, right? And then once you are done with all interpretation, guidance, supervision, or you can say consultancy from the consulate, from the AICPA, from internal board, from quality controls, everywhere, all the information you have gathered and you have done all the documentation. Now it's being your responsibility as a CPA to evaluate whether you need to go with that engagement or you want to withdraw from the engagement. So this is being your prime responsibility, or this is your prerogative to take the decision whether you wanted to continue with that engagement or you wanted to withdraw from the engagement. No counsel will say withdraw from engagement, no consultation will say withdraw from engagement, no supervisor will say withdraw from engagement. They can only give you right and wrong things, right? It's being a CPA who is the ultimate signing partner of that respective engagement has to take the decision whether he or she wants to go ahead with that engagement or he or she would not want to go ahead with that engagement, right? This is completely your own individual, or you can say as a group together, if you are in a joint audit, would be your responsibility to take the decision whether you want to continue with that engagement or you wanted to withdraw from that engagement, right? So these are certain threats when to accept the engagement or when not to accept the engagement, and you need to consider certain rules to accept that engagement or not to accept that engagement, right? Next is documentation.
So, sir,
Documentation is
these threads are just under the first head, that is integrity, and okay.
yes.
So we don't have
It is
anything under other
other
rules.
law, yes, other rules. So this is all about integrity and objectivity rules. So they are not applicable in independence rule, general rules, accounting principle, or discoverability act.
Okay.
So these all comes in this one, right? This table will help you during your exam time, I'm telling you, because like people get confused. If we go by literature one after the another, then people get confused, like where exactly this thing is located and which rule required me to follow this or not to follow this. But by this table, you can easily point it out where exactly I need to look for. Next is documentation. Documentation, like I said, work not documented, work not done, right? So keep this into your blood and brain both. Work as an auditor, as a CPA, work not documented is work not done. So both integrity and objectivity rule require you to document the identified threats and the safeguard you have applied, as well as independence rules are also require you to document the identified threat for the independence and the safeguard you have applied for that, right? Next are certain examples of threat. So these 7 example of independence threats. So these threats are only and only for the independence threat. So it's not to integrity and objectivity, not to any other rules. So these are dedicated and specific to the independence rules, and all these 7 threats are very much important, and we'll be learning in detail about all these 7 threats also. And in your exam, you will definitely see 1 or 2 questions from these threats. So first one is the adverse interest. What is the threat over here? That means your interest is different than the client interest. You want, like, for example, let's say in automobile industry, we have Honda, we have Maruti, we have Toyota, and we have Mahindra, let's say, right? So for example, you are doing audit of, let's say, Mahindra and Mahindra, and you have made an investment in, let's say, Honda. You want the Honda share price to go up, and there might be things you want, like Mahindra and Mahindra price should go down, then only your Honda share price will go up. So here you have adverse interest. So your interest is in competition. Then there might be a possibility that you will leak certain confidential information to Honda, right? That Mahindra is, let's say, you're doing audit of Mahindra, and there might be a possibility that Mahindra is coming into the EV vehicle very soon, and they have signed up an agreement, let's say, with any company to start production of the EV vehicle. And let's say you have interest in Skoda, or you have interest in Honda, and you go to the Honda management that Mahindra is making a deal for the EV manufacturing with the respective vendor. Then it may be possible that Honda can go to the respective vendor and make a better deal, right? So there might be a possibility that you may have adverse interest. That is also a threat to your independence. Even though you do not have any direct interest in Mahindra, you do not have any shareholding, neither you nor any of your family member, but you have adverse interest in the competition. So in that case of scenario also, your independence is under threat. Second is advocacy threat. Advocacy threat, like we have discussed an example earlier also, like for example, earlier year you have given any recommendation or consulting to the management for any particular accounting matter, or maybe any taxation matter, or maybe any legal matter, right? In which you have given a favorable impact to the management judgment, or favorable support to the management judgment for any litigation matter. Now you have been appointed as an auditor of that company. So that means in earlier period you have given a favorable judgment or favorable consultancy to support in favor of the management, but as an auditor now you cannot challenge that position, right? Because you cannot challenge yourself, right? Or maybe let's say you are representing your client in front of the IRS, right? In that case of scenario, you'll always be defending your client. You'll not be saying your client has done the wrong. So in that case of scenario, also your independence is under threat, right? Your independence is not clear. Next is familiarity. This is very much common problem in the audit business. In India, like it has been broken in 2013 when this New Companies Act 2013 came up, but in US it's still there. So in India we have like every 5-year rotation of audit plan, right? As per the company law, it is required in every 5 years you need to rotate the auditor. But in US, rotation of the auditor is not mandatory. But whereas PCOB require every 5 years you need to change the CPA, signing partner, but not required to change the firm. Like for example, like when I was doing the audit of General Motors, so from last 99 years, Deloitte was the auditor of General Motors, right? So in US, it's not mandatory to change the firm. There's no regulatory requirement to change the firm, but it's for PCOB and SEC rules and regulation, it is required to change the engagement partner, but not the firm, right? In that case of scenario, when you are doing continuously long term for any audit engagement, you get familiar with the client, you get familiar with the accounting policy, you get familiar with the practices, and some practices you have accepted already. Now it is difficult for you to go back and challenge. Then client will say why you have accepted that previous year, right? Those kind of problems are very much, you can say almost in all engagement we see in US, right? So that's called familiarity threat. Any doubt here so far? Adverse interest, advocacy, familiarity.
Hello, sir.
Yeah,
yes. I'm leaving the class. I have some work. I'll see it later.
Okay, no problem.
Okay, thank you.
Next is management participation. If you are participating in management responsibility, what are management responsibility? Design, implementation, and maintenance of internal control, preparation of financial statement, making the budgets, reviewing the budget, or like HR support services, accounting, bookkeeping, then also it's a threat to an independence. Next is self-interest threat. That means if you have your personal interest in the client, that means if you have direct or indirect interest in the client, that's also is a threat to independence. Next one is undue influence. That means either your partner or you can say office managing partner, engagement partner, quality review partner, they have direct influence on the client, or the client may have direct influence on the engagement team member. That also comes under the threat. So we'll be discussing all these 7 threats in detail, and these all 7 threats are very important for your exam point of view as well, right? But this we'll be covering in next class. Next one is guidance to any doubts so far? Let it at very high level on these threats to the independence.
I guess we left self-review. Number 6.
Okay, number 6, self-review. So like we were discussing, like let's say in 2018 when ASC 606 has been implemented, right? For example, like there's a client called, let's say, Trimble. Trimble is an technology client, and for them auditor is EY, right? And back in 2017 and 18, and they have taken a consultation, let's say, from PwC, how to apply the ASC 606 and impact of the ASC 606 on their accounting, right? What need to be recognized upfront, what need to recognize over the period of time, what would be the unearned revenue, and what would be the collections. So in that case of scenario, like PwC has given a detailed consultancy to them, and they have done the complete analysis of the impact of ASC 606 on the Trimble financial statement, right? And which, like EY back in 2018, let's say, challenge, and they are not comfortable with what consulting they have got from PwC or interpretation of the accounting standard according to them is not appropriate, taken by the management in consultation with the PwC, and they have given a qualified opinion, right? In next 2020, let's say they have appointed PwC as an auditor. So here PwC has given the consultation on the application of the ASC 606. Now they cannot go back and challenge what consultancy they have given, right? That is a threat to the self-review. That means they have already given a consultancy, they have already charged a good amount of fees, they have already provided like professional consultancy to the company. Now, for example, if they need to change the stand, then it would be very hard for them, and client will also not accept it, right? Those kind of threats are called self-review threat. Or for example, sometime in small size firm or mid-size firm, like CPA make like lot of schedules for the financial statement. Sometimes CPA do compilations of the financial statement also. In that case of scenario also, it's a self-review threat. Like what you have classified as a short term, or what you have classified as a long term, you will not be challenging yourself, right? Or maybe like initially the company has appointed you for the compilation engagement, and later on they ask you to do the audit of that engagement, right? If you have done the compilation, then you would not be challenging whether the classification of current assets, current liability is right or wrong, classification of current assets and non-current assets is right or wrong, right? Because you yourself have done the compilation services for that client. So that is called self-review threat.
So in that case, I guess advocacy and self-review are quite interrelated, no?
Yeah, you can say so, but advocacy are more of like representing in front of, you can say, IRS, or maybe giving legal services. More advocacy is more toward like when you are selling, like we were discussing morning, an example of insurance agent. So where you are advocating your insurance company and you are selling their products and services like 𝐊𝐴, Modicare products, for example, or maybe like Oriflame products. Let's say, for example, you are a distributor or maybe like an agent of those products, and at the same time you are doing the audit of that client. So there you are doing the advocacy of the respective product and service, or maybe advocacy can be like selling of the product and service. It can be advocacy can be in any legal matter where your legal team is supporting the client, or maybe advocacy on any accounting matter or tax related matter. Whereas self-review is, that means, for example, you have done the debtor agings for the client and you have identified like these are the debtors which are more than 1 year old and required to make the provision, right? And client has accepted that as it is. Then you will not be in a position to review that debtor aging because you yourself has made for it, right?
Okay.
So that is called self-review threat, that you will not be in a position to do the self-review which you have done work for the client. For example, let's say you have done like industry analysis, and basis that you ask company to create provision, let's say for the warranty provision, right? You have done the industry analysis. Let's say you are doing audit of General Motors, who is having like, let's say 1% of the sales as a warranty provision they are maintaining it, right? You have done the industry analysis, what Tesla is doing, what Ford is doing, what Honda is doing, what BMW is doing, what Tata is doing, and accordingly you come to an average that it should be ideally 1.5%. And you have given a recommendation to the management, like based on the industry trend, it should be 1.5%, and based on historically how warranty claims are increasing, it should be 1.5%. And management has accepted your point, and they have increased the provision. Now, how can you go back and challenge what you have recommended to the management?
Okay.
Right. So next one is guidance to address the ethical conflicts. So if there is any conflicts on account of ethics, right? So which guidance you should be referred to? ethics conflict rules. So there are separate rule which is called ethics and conflict rules. So that you need to adhere to. That comes under the objectivity and integrity rule. They comes under the independence rules, and they comes into the accounting principle rules also. So wherever you have any ethics related issue, you need to follow back to the ethical and conflict related rules. Eighth is, in absence of any guidance and interpretation, what you need to do. So if there is no interpretation or guidance, then you need to go back to the conceptual framework given under the AICPA, right? So here, wherever you do not have clear interpretation and guidance, then you go to the base, which is a conceptual framework. That applies to independence rules, applies to objectivity and integrity, and general standard rule. In case of accounting principle rule, then you need to go to the accounting principle rule and conceptual framework both. So you need to look at both. Next is deviation from accounting principle. This is only for the rule number 4, which is accounting principle rule. So if there is any deviation in accounting principle, how you need to deal with that? Deviation from accounting principle is allowed only in circumstances, underline this word, only in circumstances where application of accounting principle may result into misleading the financial statement. If you are applying the standard, then it will result into misleading information. To avoid that misleading information, you can go deviation from the accounting principle. Otherwise, you cannot go into the deviation to the accounting principle rules, right? So only in 2 cases of scenario, you can deviate from the accounting principle rule. One is for the better presentation, and second is if accounting principle, accounting rule, accounting standard may result into misleading information. So in certain industries, there are cases, there are scenarios that you cannot apply the standard rule. Rather, you will be apply the industry practice, which is being more prevalent in those respective industry, and more fair presentation of the financial statement based on those industry practice, right? So these are exception to the general rule. 10th one is the financial reporting framework other than GAAP. So generally we use GAAP or other acceptable accounting principle like IFRS, or required by any statutory contract or agreement or reporting requirement. So you need to follow the US GAAP if you are preparing the financial statement as per US GAAP. If you are preparing the financial statement as per IFRS, then you'll be using IFRS. And if you are doing special purpose reporting framework, then you'll be using that respective special purpose reporting framework.
So, sir, just a question here. So, is it mandatory to follow GAAP if you are listed on like New York Stock Exchange, or is it on the discretion of management to follow maybe IFRS even if they are listed on New York Stock Exchange? So, is there any mandatory rule?
Yeah, very good question, Gurmeher. For all the company who are based in US and they have operation only in US, they need to follow US GAAP. But the company who have operation internationally also, and they are listed on stock exchange in US as well as different stock exchange in the world, they can either choose for US GAAP or IFRS, but they need to disclose which GAAP or which reporting framework they are using it.
Okay, and if like they have operations in Europe as well, but they are listed only in US, so they have an option to apply like follow IFRS as well.
Yes. The company who have operation outside US and are listed on stock exchange, they can opt either US GAAP or IFRS, but they need to make appropriate disclosure accordingly.
Okay, and for private firms in US, they have to apply. Yeah, okay.
Yes. Very good question, Gurmeet. Member CPA firm work paper. So what all rules relating to the CPA work paper? That means you all guys are doing audit, right? You might be making a lot of schedules, you might be making a lot of notes, you might be making a lot of work paper, right? So who is the owner of those work papers? So audit work paper are the work paper of CPA, not of management. So a lot of time student get confused whether, let's say I have taken a schedule of, let's say, aging analysis of the customer from the management, whether it's a management work paper or it's a CPA work paper, right? Let's say you have taken a AR aging schedule, account receivable aging schedule, and on that you have done all the analysis, make all your notes, make all your interpretation, make all your conclusion, and converted that into your own work paper, right? This is your audit work paper. This is no more be a management work paper, right? And those all are being your ownership, your own work paper, right? So member CPA work papers rules are, member working papers are member property. So CPA work papers are CPA property. So what all kind of work paper would be there? So there would be like tax returns, for example, you have taken from the client, and you have done all your, you can say, footing, cross-footing, all your explanation, taking, tying, everything, and converted that into your work paper, right? Your audit program, your audit schedule, your, you can say, analytical review, whether it's an oral analytical review, disaggregated analytical review, conclusion review, sample test which you have done, like whether test of control, walkthrough, test of detail, all the inspection of the documents you have done. Based on the inspection, you have made your own work paper, what all things you have verified, physical verification work paper of the inventory count, right? Schedule prepared by the accounts department, which you have used for the audit purpose, SAD, journal entry proposed. So all these are like an example of CPA work paper, and it's being your property, right? It's not management property. You are not required to give this document back to the management. Make sense? Yeah.
I just have a question. So they're listed under rule number 5.
Rule number 4 and 5 both. So one is accounting principle rules. The 6th one, 5th one is act descriptability rule. Yes.
So these work papers were listed in the last column.
Mm-hmm.
So I just want to understand, why is it just related to this credibility rule? Because they most of them are general, maybe come under general standard rules or other rules. So why is it listed only under like the last rule?
Yeah, no, very good point, Gurmeher, here. Because why it is in descriptability rule is differentiation between what is management work paper and what is auditor work paper. Because here, if you are not giving back the management work paper, or if you're not giving the management document back within 45 days after completion of your audit, it will result into discreditability for the CPA, right? Here, a lot of time they have confusion, what is management work paper and what is CPA work paper. So to avoid those confusion, they have given certain illustrative example. These all are CPA work paper. Other than that, like minutes of the meeting, for example, for shareholder meetings, agreements, right? So all those documents, purchase order, sales order, invoices, right? Or payroll register, they all are being management paper, which management document, which you need to give it back to the management within 45 days of completion of your audit. So that's the reason it has given the illustration and examples over here.
Okay, got it.
Cool. Okay. Now rules to return the client record, 45 days, which we have discussed, confidentiality of information. So here, as a member should maintain the confidentiality of his or her employer or firm. So here you are not only required to maintain the confidentiality of the client information, but to your CPA firm also. That means you are a CPA, you should not go outside and say my firm is doing this work for this client. So my firm is not involved in like merger and acquisition of this client. So you should not go and say loud all this confidential information to outside world. So that's also you need to maintain the confidentiality of the firm as well. Next one is exception to the rule. There may be instance of unusual circumstances that may make the financial statement misleading when applying the GAAP. Deviation from the accounting principle is allowed for the better presentation. This we discuss, I think, here as well. Deviation from accounting principle. So deviation from accounting principle is possible only in two instances: when it is misleading to apply, and second, when it is more better and fair presentation of the financial statement. So in only those case of scenario, you can apply, you can deviate from the accounting principle or accounting standard. Other than that, you need to follow accounting standards, right? So these are rule 1, 2, 3, 4, and 5, right?